Hello and welcome to TrueCode Capital's webinar here. We're going to talk about the halving cycle and what's interesting about that and why you should care and why that might make an impact on your portfolio. So my name is Josh Peck. I'm the founder of TrueCode Capital and invented the strategy that we operate over here. I have a long history in working with cryptocurrency, started in about 2013. I started accumulating a little bit of Bitcoin. By 2017, that was over half of our family office here. And it really was an uncomfortable feeling for us. So we had to really professionalize that process so that we were, being good stewards of capital and participate in the growth of crypto as it goes on. So that's really what we're focused on here. And over time, we've opened that up to outside investment through TrueCode Capital. In the meantime, I also wrote a book, Cryptocurrency Risk Management, a guide for family wealth managers, where I took a lot of those lessons that I learned in the past decade or so, and a lot of the hard knocks that I had to take along the way, so other people maybe don't have to take those as well. So that's out in the public now, and actually it's gotten a fair amount of press in the recent history just because I think I was the only one talking about crypto risk management when FTX went kaput. So it was kind of a fortunate thing for me, even if it's unfortunate for a lot of other people. We got a lot of coverage out of it, and we're excited to kind of get the message out there that there's a more thoughtful way to approach crypto investing. And people can, invest in the asset class, and if they educate themselves, it can be, far less risky than, what is perceived in the popular idiom, I guess. So let's talk about the Bitcoin halving a bit. Well, what is it, and why should you care? I think the interesting thing about the Bitcoin market is that it's this first world where that we're seeing the mining and everything is happening inside the internet. So the rules for that are a little bit different than, let's say mining gold or mining something else. And so it just pays to understand what those rules are. Pardon me. And so if you understand what those rules are, then, sometimes you can find a little bit of an edge, or you can find an opportunity there that maybe you wouldn't know was there if you were less familiar with it. So you can educate yourself a bit, and, education often kind of helps us find opportunities. So let's talk about Bitcoin mining. So whenever they designed Bitcoin, there needed to be a method for tokens to be issued into the market. Right. And so if you think about it, you don't want to just dump all the tokens on the market at once, because then the value will kind of always be very, very near zero. But if there's a method to allocate some out in the market over time and trickle them out a bit, then there's an opportunity. Then, early adopters can, be rewarded for their early investments, and you create a virtuous cycle where that people can participate in the network, earn money, and then potentially early adopters can make some money, and everybody gets to make money, and the network is stable. So in the crypto network, the miners are the mechanism by which blocks are added to the blockchain, and they get a reward for that work that they do. And so whenever a block is added to the blockchain, the miner gets a reward, and the halving event is when that reward gets cut in half. And so every 4 years roughly, the reward to miners gets cut in half. And right now that reward's about 6 1/4 Bitcoin, and so it'll go to 3 1/8 around around May 2024. And so the Bitcoin halving itself is just codified into the software. It's not something that anyone can change, unless they do like a 51% attack on the crypto network, or they, control all the nodes and somehow are able to change the rules of Bitcoin. But the interesting thing about it is that this halving event that affects the mining reward has caused these fantastic market fluctuations. And so I think part of these market fluctuations we've seen in Bitcoin over the past number of years around this halving event They're part of that, some fraction of that is reasonable. It's because of, the new supply of Bitcoin is being reduced by half. And so that causes an upward lift on the price pressure in Bitcoin. And then there's total manias that ensue, and so some fraction of that is reasonable. And then there's, a mania that ensues, and then the price, as many people know who read the paper, it crashes back down periodically. And so when we're looking at these, we really want to understand this Bitcoin mining process in a little more depth. So like I mentioned earlier, when we think about blockchains, there's it's just a series of blocks. Engineers are notoriously lazy with naming things. When something's a black and it's a hole in space, we call it a black hole, right? It's a chain of blocks. Great. Well, these blocks all hold the transactions in the Bitcoin network. So each transaction gets routed to the network through a node usually, and then then the network bundles those into blocks, and miners sort of solve a complex cryptographic puzzle that earns them a reward, and then they get to add that block to the end of the blockchain. And this blockchain is immutable. Once this block is added, it can't be changed. It goes, and so if you want to run like a full node on your computer, basically you go down the Bitcoin client, and then you go start downloading the blockchain from this peer-to-peer network. And it takes like 3 or 4 days, because every transaction that's ever occurred in Bitcoin, you're downloading to your computer, and all the addresses all the way back to what they call the Genesis block, block number 1. They have longer cryptographic names for them, but we can just call it block number 1. And so whenever this reward to the miners gets cut in half, that causes like a lot of readjustment in the network, because all of a sudden the miners have to pay their electric bill. And, there's a lot of interesting things that go along with that. But the economic factor here is that miners have to pay their electric bill. And so they are forced to sell more Bitcoin, and then that causes a fluctuation in the price. And then when prices are high, mining becomes super profitable. And we'll talk about that a little bit more later. But this is kind of the big picture here of how mining fits into the network. So if you're a user and you want to transmit a transaction, you want to send me some money or send me some Bitcoin, you're going to route that through a node. It's going to go out to the network. It's going to get bundled into a block. A miner's going to solve that block, and then it's going to be appended there by this little consensus method that's, pretty complicated, but it seems to work pretty well. And you can kind of see how this works over the past number of years, or past number of halving events, where that, in 2009 when Bitcoin started, the reward was 50 Bitcoin per block that was solved, and people were solving them, just with the everyday computers. And now a few years later, it's not even that many years later, in 2023, the computers they're using to solve these blocks are, specially designed ASICs, custom designed hardware just to solve these specific blocks. It uses a lot of electricity, which people have been critical about. But you can kind of see that the reward is decreasing, and the total supply of Bitcoin, a lot of it's out there already. So the total supply of Bitcoin really, is most of it's out there at this point, and then it'll, the last little bits of it will continue to be deployed through this mining process over the next, 100 years or so. So this is kind of how it looks when you're trying to figure out, like, okay, well, how do these rewards keep having, and how do we get all of the Bitcoin out into the public? And one of the things that I think is exciting about this is that, most of the Bitcoin's already out there. And, Pew Research recently, at the peak of the market in 2021, said about 15% of Americans actually owned a Bitcoin or owned some cryptocurrency. And so that's a pretty exciting proposition as an investor, because if most of the people on the planet don't own it, and there's seems to be a growing demand for it, and most of it's out in the public, that's a pretty exciting opportunity for us. So while we're talking about opportunities, let's just talk about, we talked a little bit about how these halving cycles play out, and how the network works. And so you can kind of see that, these halving events have happened, every few years for a while. And we can look and see like, well, how did that play out for market prices? And we can see that it really looks like this is what's driving these boom and bust cycles in the crypto markets. So we have, a halving event, and people are starting to anticipate them because they think, oh, there's going to be lower supply of Bitcoin in the future, and that's what's probably going to go up. So even before the halving events, about a year before typically, people are starting to accumulate Bitcoin, and they're starting to spike the price a little bit. And oftentimes, like frequently happens in markets, they buy the rumor and sell the news. So it'll tank a little bit after the halving event. But we see some pretty fantastic gains if people are accumulating across these bottoms, or even just buying at the halving events. There's a lot of opportunity there if you're kind of aware of this market cycle. But if you're someone who's following the news and isn't watching this cycle, then a lot of times you'll end up buying up here or up here because it's on its way up. Everybody's excited about it. It's in the paper. It looks like it can't go down. But oftentimes that's just kind of a bad gambler's fallacy, I think, where that you're chasing the hot bets, and then sooner or later the streak ends there. So as so commonly happens, people kind of get wiped out in the process of when they're chasing things that are hot and in the news right now. So we have to be really careful about that and make sure that we're if we're going to be investing in crypto, we want to make sure we have a plan for the whole life cycle here. You don't want to just have a plan for, okay, if it just keeps going up forever, then I'm gonna do pretty well. You want to have a plan for, well, what if this goes down tomorrow and we lose 80% again, or 75, or 80 again. Things kind of in that range. And we just want to make sure that we're being thoughtful and good stewards of capital when we're doing that. And so let's walk through some of the past events. Can you imagine, like, at one time you were buying them at $12? I think I started buying into the market around $20. I was driving across town and had to go send a MoneyGram wire to some random internet guy and hope that he sent me my Bitcoin. It was a pretty terrifying prospect, but they were $20 a piece, so who cares if you didn't get too many. If you got ripped off, I guess you didn't get ripped off too bad. So, but over a period of time, they became really valuable. And the thing that you really see here is that this creates the gain from the halving date, because this is the date of the actual halving. Even though there's obviously in the past there have been some pretty good run-ups even up to the halving events, and the bottoms and the peaks are very, very desirable places to be acquiring Bitcoin, and but you definitely need to have a plan for what happens afterward. And so right now, in April 2024 or April 2023, we're sitting around 23,000, and the next halving's around May 2024. And so we don't know what the next all-time high is going to be. We don't even know what the price is going to be as of the date of the next halving. But I think that we can kind of see from this that there's pretty substantial opportunities here where we can, if history repeats a little bit, then we're going to be pretty happy with with our opportunities here. And so let's just walk through kind of how this cycle plays out and why. And I think that this is it's a structural pattern in the crypto markets where that this cycle happens because of, hard actual structural reasons that are that occur because of the, just the forces of the crypto mining and all of that. So basically what happens if we go back here to our chart, so the halving event here reduces the supply of new Bitcoin, right? Which puts a little lift on the price. Like you can imagine that would drive, if it's a new asset that people are adopting, you can imagine that would drive the price up. And so a certain amount of that, like I said before, is reasonable. It's very, if the supply of oil, if the UAE decreases the new supply of oil, oil prices tend to go up. We know that this occurs for people in lots of assets. But what usually doesn't happen is some speculative mania where that people believe they can only go up in the future. So that's what's been happening in the crypto space. So they see like a certain amount of reasonable rise in the price because of that, because of the new scarcity. Then there's the speculative mania that ensues. And when those prices go up and they go up 3x, 4x, 5x, 10x, all of a sudden that makes crypto mining like the most profitable business you can imagine. And so people are buying miners at, 5x, 10x the cost of the MSRP, that it was to buy them originally. And they're buying this because they believe that they can make so much money by mining that it's just worth it. And, it actually makes financial sense for them to do so. And so all of this new mining capacity comes online, which increases the hash rate, which is kind of the sum total of all the mining capacity in the world that's mining Bitcoin. And that hash rate skyrockets because all these new miners are coming online. People are going and digging out their old miners because they become profitable. All of a sudden, I'm plugging them in their dorm rooms or whatever they have, and so that triggers an adjustment in the difficulty. And the difficulty is a feature of the Bitcoin protocol where they try to keep the number of blocks coming out very steady and over time. So they don't want to have like 1 block today and 10 blocks tomorrow or something like that. They want to have this very steady supply of blocks coming out very regularly, because you want that when you're doing transactions. You don't want to be able to process like a lot of transactions on one day and a few the next. You want to have a very steady resolution time for all your transactions, so as this hash rate increases, the difficulty also increases, and that skyrockets behind it. And all of a sudden, and over a period of time, that mining, the people that were wildly profitable with their mining, the difficulty increases so much that they're not really that profitable anymore. And the ones who have more expensive electricity, they just have to turn them off. And and a lot of these guys, they're really mining Bitcoin as a speculative investment. They're just not just mining it and selling it the day they mine it and keeping the 5 or 10% profit that they made. They're mining it, holding it, and then so all of a sudden, so while the prices are high, they're stockpiling all this Bitcoin, and then at some point the difficulty adjusts and it forces them to start selling Bitcoin to pay their electric bills. And so as that starts to happen, then they have to keep selling and have to keep selling. Difficulty keeps adjusting up. And that usually is what kind of starts triggering this panic in the market, because all of a sudden there's a new supply of Bitcoin right at the very highest prices. And so when that new supply, hits the street, so to speak, and buyers are kind of exhausted from, all the mania phase, then oftentimes that's kind of what starts to trigger push the price back down. So miners are saying, okay, well, we've got to pay our electric bills. We're going to go turn around and push these coins that we've had in our stockpiles back on the market. Try to survive for a while until prices start rising again, and somewhat predictably, prices start crashing. Right, because there's a lot of new supply. Investors who were just here for the get rich quick part, all of a sudden they panic, they start selling, and that's really what's causing these big booms and busts that we see here in the crypto market. And so here miners are making lots of money. Here they're not making very much money, and and that's usually on the way down. They're not making as much money because the difficulty is still really high. Now, the difficulty will adjust down over time. So as it starts to adjust down, mining becomes slightly more profitable, but oftentimes the price outruns the difficulty adjustment. So people end up having to sell out of their mining hardware a little faster than they'd like to. In fact, I remember in 2018, 2019, there were times they were selling mining hardware for scrap metal prices. They were just saying, okay, we've got 10,000 pounds of Bitcoin miners. Whoever has a truck and can haul them off can basically buy them. There's people who have a strategy around that, and they'll just buy the miners during the bust times and run them during the boom times, and some of them do very well doing that. But for my purposes, as an asset manager who's a little more focused on quant than mining, I really see this as a cycle that we really just want to participate in when it's up, and stay out of the way of on the way down. And so, in my mind, these times, these troubled times, are the times when smart investors accumulate, as opposed to here at the tops, or when it's in the news, or things like that is usually when investors kind of get hurt. So from my perspective, this provides like a wonderful opportunity for patient and thoughtful investors to develop a strategy around this halving cycle, so they can potentially create awful lot of wealth. And I think that's kind of the phase that we find ourselves in now. We're sitting here post FTX. We've had quite a lot of really negative press for Bitcoin in the media. We've seen the price drop 75% from peak to trough in 2022. And I think that the smart investors are sitting here and not just saying, oh, I can call the bottom and I'm just going to go in because I know exactly where the bottom is. But what they're doing is they're starting to accumulate, and if they want to get to their 1% allocation, 3% allocation, 5, 10, whatever it is, they're starting to get that over a period of weeks and months, so that they can potentially participate in the next run up, because May 2024 is just about a little over a year away. So at this point, and I think this is what makes this so exciting to me is, as a person who's kind of quantitatively oriented, you're really always looking for asymmetric opportunities. Anytime that you see something that has a log chart, kind of that hockey stick up and to the right on the right there, that's a pretty exciting opportunity. And for our purposes, if we're sitting here and we say, okay, well, Bitcoin's had a 75% drawdown, well, how much of a gain does it take to get back to the former all-time highs? What's the size of that opportunity between here and here? Like even if it just goes back to the former all-time highs, or as it's drawn down here about 75%, if it goes back up to the mid 60,000s, that the size of that opportunity is about a 3x in there. That's a really exciting opportunity for an investor, where that you can buy an asset for 25 cents on the dollar and write it back up to the dollar potentially. So if you believe in the long-term thesis of Bitcoin will tend to go up because there's a very limited supply, like we spoke about earlier, and there's a number of, and there's increase in adoption, that's a pretty big opportunity for people. So, the first thing most people say to challenge this idea is, well, what about the Fed? And, we've certainly heard a lot about the Fed this year, and there's been, a lot of negative press about it, and it certainly crippled a lot of markets. But I went back and actually ran this, and I said, okay, well, let's go map the money supply versus Bitcoin and say, well, how much, kind of making a decision here, like how much of this speculative bubble or how much of this speculation do we think is because of the increase in M2? And I feel like we can pretty well put a pin in that thesis, is that, while the money supply has increased by 71%, which should be terrifying to anyone who's a student of financial history, since 2016. At the same time, Bitcoin doesn't seem to be really moved by that too much. It's not nearly as correlated in my mind as the halving events are. This seems to be like very predictive in its approach, as opposed to this where that it's very, it's pretty thin to say that that's what's driving the markets there. So that's not something that I really, that's not a thesis I really hold too much. So as time goes on, we'll see. I think that the M2, the changes to the money supply actually do affect investor psychology a bit, as opposed to having any structural relationship to the crypto markets. This structural relationship with the crypto market seems to exist and seems to be playing out on a fairly regular basis. So, I think that this is a stronger thesis for explaining the insane growth that we've seen over the past number of years. And so to wrap up, I think that it's fair to say that that the thesis that Bitcoin halvings move the market, it's pretty sound. And I think that we can safely say there are structural reasons for it. Certainly the mining process and how the difficulty adjusts on a little bit of a lag there has some interesting effects for that market. And we've seen the manias, and I'm not the only guy that's noticing this stuff. Like, there's a lot of other investors out there who are noticing it too. And so I think that, we if anything, I think we're seeing more anticipation of this market move. I think even perhaps some of the reasons for the subdued highs in 2021 and the first part of 2022 may be because people were anticipating it and they just kind of were selling out early, trying to get ahead of this cycle, anticipating this crash. So we'll see what happens in, between now and, 2025, basically. But, that anticipation, I think, is really interesting for the market. And in fact, this year, one of the things that we noticed was that the bottoming process that happened after the peak of the market, after the big run up, instead of starting about a year before the next halving, it actually started, because in past market cycles, it started 60 to 70, 55 to 75. So instead of being 75 or starting about 75 or 80 weeks before the next halving cycle, it actually started about 10 weeks earlier. So it started about 90 weeks before the next halving cycle, which kind of includes me in that, like, we're not the only people watching this. There's lots of people watching this. So, and from my perspective, that cycle playing out repeatedly provides this wonderful asymmetric opportunity for investors to participate in, a very asymmetric way, where that if they deploy capital here, they're buying something for 25 cents on the dollar. Even if it doesn't make all-time new highs in the future, that can still be a pretty desirable opportunity. I mean, there's no guarantees, but an opportunity to buy something for 25 cents on the dollar, maybe it goes back up and it has a history of rising 80, 20, even a 3x, 5x off the next all-time high can be pretty interesting. So we'll see what happens, but I think that's what's pretty exciting about it for us. So we wanted to make sure that people understood that it's out here, and that it's happening, and hopefully it keeps people makes people a little more cautious here at the peaks. So they're not like, hey, let's go keep buying, at the top of the market. Let's temper that enthusiasm at the top of the market and bring it kind of at the bottom of the market. We need to be thinking a little bit more in terms of the full market cycle, as opposed to thinking just like, oh, well, it's hot right now, so we want to hop on board. And hopefully over time that'll settle down a little bit and people will understand what's going on a little bit. And so a big part of what we do here at TrueCode is we do a lot of education. And so if you want to connect with us, we have some quizzes on the website. I have a book out that, you guys can read and download and Kindle, and you can go buy the paper version if you're a Neanderthal like me. And so you can read a lot of the information that I use to help build this, to build the fund. And a lot of that is rooted around the notion of how do we avoid total loss while investing in crypto, because you kind of in the crypto market, you don't really have to be too clever to make your equity account go up. What you have to do is avoid getting wiped out by things like FTX or stuff like that. So we actually have a checklist in the back of that book that is a checklist of questions to ask your asset manager,
And especially if that asset manager is you, then you definitely want to ask those questions of yourself, like where are you backing up your keys? How are you going to do custody? Who's going to be in charge of what? And where are your counterparties? So, like if you're going to trade on an exchange, where are they at? If you ever have to execute a lawsuit against them, you want to be able to do so without having to fly to some weird country that maybe has funny laws that you don't really understand, or they're pretty opaque to you. And we also have a lot of events. Subscribe to our email list. We put out a lot of webinars, and generally just try to be a good steward in the crypto economy, so that we're giving people good advice and good information, so that they can make their own decisions about what they want to do. And then of course my email's here. So usually people just want to argue with me. So if you want to do that, that's fine too. We like having spirited discussions about crypto, and for whatever reason, seems to be one of the things that we do in the crypto world. So we're going to keep doing that. So and so if you guys need anything, just give me a shout, and I'm happy to connect with anyone and talk about some of the educational stuff, or talk about the fund that we have, because we think we have a pretty good product there, and I'd be glad to chat with anybody about it. But with that, I'll thank you for your time, and hopefully we'll see you at some of the upcoming webinars.